Today, we're diving into a gold trading strategy that's all about one thing: keeping it simple. It's a completely mechanical model, and the whole idea is to take emotion out of the equation to hopefully find some real consistency. So let's see how it works. And when we talk about consistency, this is the kind of result we're talking about. Apparently, one student locked in a $100,000 payout using the exact step-by-step process we are about to go through. The claim is pretty bold. By getting rid of complexity, you open the door to consistency. This quote you see here, this is the entire philosophy in a nutshell. The whole system is designed to stop what they call analysis paralysis. You know that feeling, right? When you're just staring at charts, totally overwhelmed by all the information. Yeah, this is built to avoid that, relying on a clear, repeatable set of rules instead. All right, so here's our game plan for breaking this all down. We're going to follow the exact same path a trader would. First, we figure out the trend. Then, we find a high probability zone to watch. After that, we look for a really unique confirmation signal. And finally, we'll cover the two specific ways you can enter a trade. Let's jump into it. So first things first, what's really under the hood of this strategy? Before we get into all the how-tos, we gotta understand the what. And at its heart, it's a completely rules-based, mechanical trading model built for one thing and one thing only: gold. This right here lays out the four pillars of the strategy. Number one, the focus is only on gold. That's it. Two, the goal is to always trade in the direction of the market's dominant momentum, what the system calls order flow. And finally, it's mechanical. It's all about following rules to take any of the guesswork or emotional decisions right out of the process. Now, according to this model, this next part is absolutely crucial, because if you get the market direction wrong, well, none of the other steps even matter, right? That's why everything kicks off with a super simple rapid-fire test to figure out the trend. Before we get to the actual test, let's just quickly nail down this term order flow. It's just a fancy way of saying the dominant direction of the market. As you can see, if you're seeing a clear pattern of higher highs and higher lows, that's a bullish order flow. If you're seeing lower lows and lower highs, it's bearish. Simple as that. And this is the test itself. It's brilliant. You open up a higher time frame chart, like the 1 hour or the 4 hour. And the rule is you have to know instantly, within 3 seconds, if the market is going up or down. If you have to squint or think about it for even a moment, that means the market is choppy, it's consolidating. And the rule is, you do nothing. You just stay out. Okay, so you've passed the 3-second test. You know which way the river is flowing. What's next? Now you need to pinpoint a specific area of interest on the chart. This is the spot where you're going to patiently wait for a potential trade setup. And that area of interest is called a fair value gap, or FVG for short. Just think of it like a little vacuum or an imbalance in the market. You can spot it pretty easily. It's a 3-candle pattern where there's a literal gap between the wick of the first candle and the wick of the third. The whole idea is that price often gets drawn back to these areas to, well, fill the gap. And the rule for using these gaps couldn't be more straightforward. You only, and I mean only, trade in the direction of the trend you already identified. So if the trend is bullish, you're just waiting for the price to pull back down into a bullish FVG. If it's bearish, you're waiting for it to rally up into a bearish FVG. You're never fighting the trend. Okay, so you've got your trend, and you've found your high probability zone. Now comes the trigger. This is the specific signal that tells you a trade might actually be ready to go. And for this part, the strategy looks at a completely different asset: silver. This signal is called SMT divergence. Now, you know gold and silver are usually highly correlated, right? They tend to move together like dance partners. A divergence is what happens when they suddenly fall out of sync. This little disagreement between the two is used as a really powerful heads up that the current price move might be running out of steam. Let's look at a perfect example here to make it crystal clear. Imagine gold has pushed up into that bearish FVG you were watching. It makes a high, but then it fails to make a new high. It just runs out of gas. At that exact same moment, you glance over at the silver chart, and guess what? Silver did make a new high. That disagreement, where silver looks strong but gold looks weak, that is the exact bearish SMT divergence this strategy waits for. Okay, we have our trend, our zone, and our confirmation signal. Now for the final piece of the puzzle, the actual entry. This strategy gives you two distinct rules-based models for how to pull the trigger. So the first entry is called CISD. It stands for Change in State of Delivery, but don't get hung up on the name. Just think of it as a momentum entry. So for a short trade, you'd look for a little pullback, like a series of at least 3 green candles in a row. The trade gets triggered the moment a candle closes decisively below that little block of green candles, signaling a rapid shift back in favor of the main trend. The second model is a bit more of a classic pattern. It's called a market structure shift. Now, this one is your standard break and retest. So here, you'd wait for the price to break a recent swing low in a bearish setup. Then, you wait for it to come back up and retest that level it just broke. It's a more conservative entry, giving you a little more confirmation before you jump in.
All right, theory is great, but let's put it all together and see it work. We're going to walk through a complete bearish trade example, step by step, to see how every single one of these rules clicks together in a wheel scenario.
So here it is. Let's walk through it. First, the 3-second test on the 1-hour chart shows a clear bearish trend. Lower lows, lower highs. Check. Second, the price rallies right up into a bearish 1-hour FVG. That's our zone. Check. Third, on the 5-minute chart, that SMT divergence pops up, confirming weakness. Gold fails to make a new high, but silver does. Check. Fourth, the CSID entry signal appears. We're in. And finally, the trade is managed with a stop loss just above the high, and the target is a clean 1-to-2 risk-to-reward ratio. So, to wrap it all up, this is the entire strategy in a simple checklist. You identify the higher time frame trend. You mark the right FVG zones. You wait for price to come to you. You look for that SMT confirmation with silver on the lower time frame. You execute with either the CISD or the market structure shift, and you aim for a simple 1-to-2 risk to reward. That's the whole playbook. And all of this brings us to a really big question, doesn't it? This whole strategy is built on the belief that strict, simple rules are the key to success. But it makes you wonder, can a purely mechanical system, one that actively removes your own judgment, ever truly outperform a seasoned trader's gut feeling, their intuition? It's the ultimate debate between systematic trading and discretionary trading, and this strategy plants its flag firmly on one side.